Good morning. Wanted to take a minute today to talk a little bit about something that's been in the news here recently that has caused some people some concern. You may have seen this as well, that the number of adjustable rate mortgages have been increasing, or applications for adjustable rate mortgages. In fact, their share of all mortgage applications is up to 10.8%, which is the highest it's been since 2008. Now, that might be a little bit of concern for some people because many of us remember that the adjustable rate mortgages were a contributing factor in the housing market collapse here about 15 years ago. So, are we looking at the same thing now? Well, no, probably not, and for a couple of reasons. But first of all, let's talk about some key facts about adjustable rate mortgages that may be good to keep in mind. And as we do this, remember that I am not a finance guy. These are general guidelines that may or may not apply to whatever loan package you're looking at. So don't take what I'm saying here as being something that absolutely applies to what you're doing. These are just some general guidelines. So what is an adjustable rate mortgage? Well, we know that in a standard mortgage, you have a set term, maybe 15 or 30 years, and the mortgage rate will remain, or the interest rate will remain the same for the period of that mortgage. That's nice because it gives you the certainty of what your mortgage rate will be, and you'll be able to know from your amortization tables what your payments will be every single month for the life of the loan. How much is going to go to interest? How much is going to go to principal? It gives you a lot of certainty going forward, and that's a valuable thing. But look at it from the point of view of the lender. They're looking at this and they're saying that they have given you a loan, let's say, for 5%. But if what happens next is that interest rates more broadly rise, then what they have to pay is going to go up, but what they're getting from you is staying static. So for them, they might like it if they could adjust your mortgage from time to time going forward. Thus, we have the adjustable rate mortgage. Effectively, you start out with a lower interest rate, as a rule, than what you would pay for a standard 30-year fixed mortgage. Now, how much lower? Well, that's going to depend on the exact package that you're getting. But it's going to be lower, in all likelihood, than the standard typical 30-year fixed mortgage. But then after a set period, likely of 3, 5, 7, or 10 years, the lender will have the right to adjust your interest rate. Now, they can't just go wild on this, and what the amount is that it can be adjusted is set out in some very specific terms in your mortgage. It's usually tied to another financial index of some sort, but that varies from package to package. So we're not going to get into that. The bottom line, though, is that it can only be adjusted under specific conditions. And even then, it can only be adjusted so often, perhaps every 6 months, every year, and only a certain amount. So they may be able to raise it only a certain number of points at that end of that initial period. And then every 6 months after that, they can adjust it a little bit more. And there may well be a lifetime cap on how much it can be adjusted. So those periodic adjustments at specified intervals, well, they're not going to be as drastic, hopefully, as we might be afraid of at times. So when does an adjustable rate mortgage make sense for somebody? Well, consider this. You are moving to Salt Lake, and you know that you're only going to be in Salt Lake for a couple or 3 years. Well, if you can get a mortgage at a lower interest rate with the confidence that you're going to be moving by the time that, or around the time that that initial period expires, then maybe taking that lower interest rate is a good deal for you because you're not going to be staying around long enough to see those hikes that could come later on. So for that situation, maybe it would make sense. Or perhaps you're somebody who, in your career, in your overall financial circumstances, you're confident that even if those rates do go up, you're going to be able to handle the payments. That's not something that you worry about. Well, then it might make sense to take that because you're able to benefit from those lower rates for that initial period. So that may be beneficial for you. Or it may be that you're confident, for whatever reasons, that interest rates are going to fall and that you'll be able to refinance when that initial period expires and maybe move to the same or even a lower interest rate. If that's how you're feeling, then maybe it makes sense. The question then, will we see adjustable rate mortgages leading to the same kind of conditions as in the financial collapse? Well, not likely, for one principal reason. Back then, a person could get an adjustable rate mortgage with little or no verification of their income. They would take advantage of drastically lowered interest rates and then walk away when the rates went up. So that led to a lot of the foreclosures that we saw. Today, those conditions have changed. A person must be able to show that they have the ability to pay back the loan even at the higher rates that may be applied once they reach the end of that initial period. So we don't have the same kind of loans being made that we did back then, and that's a protection. The banks were burned badly when this happened, and so they're more careful. Regulations have changed. So the circumstances surrounding the mortgage industry are not what they were before. So there's some things to remember. First of all, a mortgage may be with you for a very long time. So take the time to understand the details and the implications of what you're signing. Every decision you make may have unexpected results from outside your control. You don't control the interest rates, so if you choose an adjustable rate mortgage, you need to be able to live with the lack of control. And sometimes that's a psychological burden on people. And you need to know yourself whether that's something you can handle. Now, another thing to remember is that most people's attitudes toward something like an adjustable rate mortgage may be shaped in part by what they hear from other people. I'm trying to be neutral about this. Some people love these, some people hate them. I have my feelings. They're really not relevant here. But the person that you're going to hear the most from is your lender. And if your lender thinks this is a great deal, well, maybe he's right. Or maybe she's looking at this and saying, well, by going with an adjustable rate mortgage, we're able to protect the company from changes in interest rates that could otherwise affect our bottom line. So remember that what you hear from anybody may be shaped by their own concerns. So take the time to understand it and work with somebody you trust. Now, if you don't have a lender that you're working with currently and you'd like a name or two of somebody that you could work with, I'm happy to help. Again, I'm not a finance guy. I am not the guy you want giving you advice on what kind of a mortgage to get. But I'm happy to talk with you about your real estate needs. I'm happy to share contacts that may be able to help you, people who certainly know much more about this than I do. So if I can help in any way, please give me a call, 801-556-2259.